Welcome everyone, and thanks for joining me today. I want to start by talking about a significant moment in the world of investing that happened recently. A couple of weeks ago, Warren Buffett, perhaps the greatest investor of all time, announced he will step down as CEO of Berkshire Hathaway at the end of the year. For those of us who follow the markets closely, this is a bit like Willie Mays, Ted Williams, and Joe DiMaggio all retiring at the same time. It's an end of an era. Buffett's track record is nothing short of legendary. Over the past 60 years, Berkshire Hathaway delivered returns of over 5.5 million% on every dollar invested. That's an annualized gain of nearly 20%, almost double the 10.4% annualized return of the S&P 500 over that same time period. So that's just remarkable. But while Buffett's exit marks the end of a remarkable chapter in investing history, his wisdom and investing principles will continue to guide generations of investors. One of his most famous pieces of advice is, be greedy when others are fearful, and fearful when others are greedy. It's a simple but profound reminder that emotional hang-ups often lead investors astray. Buffett has always been known for keeping his investment approach simple, focusing on buying wonderful companies at attractive prices and ignoring market noise. He once said, only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. But for many of you, especially those nearing or in retirement, you don't have the luxury of simply holding forever, weathering every storm, or ignoring market downturns. This is where my approach differs slightly from Buffett's. Because retirement investing is about more than just returns. It's about stability, preservation, and reliable income. And this brings us to a critical point, the current economic backdrop. Over the past few weeks, we've discussed the challenges facing today's economy, including tariff tensions, shifting global supply chains, and economic pressures that could spark the next major market downturn. In the 1930s, for example, the Smoot-Hawley Tariff Act, which raised import duties, significantly contributed to the Great Depression by crippling international trade and exacerbating the economic collapse. Fast forward to today, we're once again seeing the impact of trade restrictions and economic uncertainty, with tariffs being one of the tools that governments are using to address imbalances. While we're not in a full-blown depression, or even teetering on a recession, in my opinion, the pressure on global trade and manufacturing could lead to continued significant market volatility, much like we saw in 2008 and during the COVID-19 crash. However, we do have some positive news to consider as well. Just last week, President Trump announced a full and comprehensive trade agreement with the UK, signaling a potential thaw in global trade tensions. UK Prime Minister Starmer joined the announcement remotely, emphasizing the importance of this deal. Additionally, the president mentioned ongoing negotiations with the European Union, hinting that further trade resolutions could be on the horizon before the July 9 expiration of the reciprocal pause. This aligns perfectly with a classic Warren Buffett quote, "A great investment opportunity occurs when a marvelous business encounters a one-time, huge, but solvable problem." For months, we've talked about how the tariff-related economic pain has been largely self-inflicted, a huge but potentially solvable problem. And now it seems we may be taking the first steps toward the solution. With that in mind, it's critical to position your portfolio for both the potential upside of a trade resolution and the ongoing volatility that may accompany these negotiations. That's why it's important to consider strategies that balance growth potential with downside protection, like fixed indexed annuities. Here's why fixed indexed annuities can be such a powerful addition to your retirement strategy. First, they're market-linked growth without market risk. You do have the opportunity to earn interest based on the performance of a market index, like the S&P 500, without direct exposure to market losses. Even when the market drops, your principal is protected. That leads us to downside protection. Unlike owning individual stocks, where a market downturn can directly impact your portfolio's value, fixed indexed annuities protect your principal from losses, a critical feature for retirees who can't afford to take a hit just as they're withdrawing funds. And of course, there's tax-deferred growth. Your gains within a fixed indexed annuity grow tax-deferred, meaning you won't pay taxes until you withdraw funds. This can be a significant advantage for those looking to maximize compounding over time. There's also lifetime income options. Many fixed indexed annuities come with options for lifetime income, providing a reliable stream of payments that you can't outlive, something traditional stock portfolios simply don't offer. And then, of course, peace of mind. Perhaps most importantly, fixed indexed annuities can reduce the stress and emotional swings that come with managing a traditional investment portfolio, allowing you to sleep better at night knowing your hard-earned savings are protected. At Perpetual Wealth Financial, we focus on helping you remove the emotional biases from your financial decisions, using a disciplined approach to managing risk and achieving long-term goals. So, as we look at the current economic landscape, with its uncertainties, shifting trade policies, and market volatility, having a plan that protects your wealth from the unexpected becomes even more critical. If you'd like to learn more about how a fixed indexed annuity might fit into your overall retirement plan, or if you're concerned about the impact of market volatility on your portfolio, I invite you to reach out and schedule a time to discuss your unique situation. Thank you for joining me today, and I look forward to helping you navigate the path to a more confident and secure retirement. We'll talk to you soon.